Hello people, this is Dr. Wang here recording. In this video clip, we're going to continue on the topic of capital structure, where was left out before the spring break. So it almost about a month ago. I hope this table looks familiar to you guys. It is about the earning per share for a levered firm. And last time when we were still in the classroom, we were working on this levered firm, unlevered firm. I hope that rings the bell in your head. Basically, if an investor prefer the return of a levered firm, then the investor can create a homemade leverage. If the investor prefer the return of an unlevered firm, whereas there's only levered firm available in the market, then the investor just to go ahead and buy the levered firm shares, but deleverage by lending some money out to create the unlevered returns. Okay, so this is something we covered before, and because the investors can either create homemade leverage or unleverage, then whether a firm has debt has leverage on its balance sheet, it does not really matter, okay, because the investors can create whatever stream they prefer based on borrowing or lending on their own, okay? And this comes from the famous Miller and Modigliani theory. Also, in this framework, we can calculate the beta of the company stocks. So basically, if we look at the company, there is assets, there's a debt and equity. So this is the beta for one company. You have the assets beta, you have the debt beta, and you also have the equity beta. And it's just like the WACC, the beta for debt takes the weight of a debt and the beta of equity multiplied by the weight of equity. Okay, and they all are under 100%. Well, the thing is, the beta could be quite different if the company takes a different debt level. For all equity firms, you can see that the debt is essentially zero. So, and the equity is 100%. So the beta for the assets is the beta for equity. And the beta of assets is really determined by the industry of the company. And the characteristics of the firm's capital structure really does not affect the beta for assets. Okay, and when the firm is levered, then the assets beta is different than the equity beta because the debt ratio and equity ratio are different now. So based on this formula, you can solve for the beta for equity. Okay, and we need to know that the beta of debt is usually very low. It is at 0. So basically, the firm's debt value is not really sensitive to the debt market. Okay, the firm's own debt is insulated from the rest of the debt market. So whether the debt market increase or decrease, it really does not change the firm's debt value because the debt is a obligation, is an agreement, is written in black and white on papers. And whether the market condition changes, the firm is still paying that cash flows, is still redeeming the same face value. But the beta for equity is a different animal because when the market changes, the firm may pay different amount of equity, the share prices could be different. So the beta of equity would be very sensitive to the market. Okay, so the financial leverage always increases as the equity beta relative to the assets beta. So right here we have an example. Let me put my myself right here. So you have a company which is all equity financed, has a beta of a 0.9, and this is a company beta, or we can say it's the assets beta. And this beta is determined by the industry. Any of the sport company in this industry may have such a beta to the rest of the financial market. And the firm has decided to lever up the capital structure to one part debt to one part equity. So it's a 50-50% debt equity financed ratio we're looking at. Since the firm will remain in the same industry, its asset beta should remain at 0.90. Well, the asset beta is determined by the earnings and all these operating activities of the company. So that part is isolated from the capital structure. So we assume the zero beta for the debt, then the equity beta would become twice as large. So this is basically solved based on the equation we had above. Okay, so this 0.9 assets beta equals to the equity ratio, which is 1/1 plus 1, that's 50% equity of the entire assets, multiplied by the equity beta. As you can see that the equity beta would be 1.8. So that basically says if the company has an overall beta of a 0.9 when the equity is a half of the assets and the other half is levered up, then the equity will be twice for the beta of the equity will be as twice large as the beta for assets. Okay, so now we know that the value of a levered firm equals to the value of an unlevered firm, and based on the Miller and Modigliani theory. So what happens if this equilibrium is broken, if the value of an unlevered firm is less than the value of levered firm? Okay, so then the investors in the market would create a strategy of buying shares of a levered firm. Okay, we'll create a strategy of buying share of an unlevered firm, and then they will sell the value. They will sell the shares of a levered firm because this is cheaper and this is more expensive. They will buy low and sell high. And what about for the investors who preferred levered return? Well, it's easy. They just buy unlevered firm shares and then borrow on their own. Okay, so they pay less prices because these shares are cheaper, and then they borrow on their own to create the return of a levered firm. So essentially, that's a cheaper strategy, and it will push up the value of an unlevered firm if the investors keep buying it. Okay, so as a result, the value of a levered firm falls and the value of an unlevered firm increases. Okay, so here is a little exercise for you. Right here we have the opposite condition, that the value of an unlevered firm gets greater than the value of a levered firm. Well, we know that this will reach back to equilibrium when the value of levered increases and the value of unlevered decreases. So what would happen there is when the investors are looking at the value of levered firm, they will buy at these shares, and then they will create the ROE of an unlevered firm, okay, by lending some money out. It's called a homemade deleverage, okay, but they will buy these shares because this would cost less, okay, they will cost less. So they will get the ROE of an unlevered firm by paying less money. So the investors will go for these kind of companies, and then that would push up the price of a levered firms. So this will eventually reach to the value of unlevered. So eventually we will reach this proposition that the value of an unlevered firm equals to the value of a levered firm. If that equilibrium is broken, the market will correct itself. Then the investors will buy the lower valued firm and then short sell the higher valued firm. Okay, so now we're agreeing on the proposition that the value of an unlevered firm equals to the value of a levered firm, given that these two kinds of firms have the same operating income and in the same industry and the same asset size. So it really does not matter whether the firm takes leverage, aka borrowing debt, or not. So right here is another proposition of Miller and Modigliani theory. So what you see here is the cost of equity. We call it RS right here. It is also return on equity. It equals to the R0, which is the overall cost of capital or the return of assets, plus the debt to equity ratio multiplied by the overall return minus the cost of debt. This equation is derived from the almighty WACC formula, the weighted average cost of capital, but we just put a tax rate at 0 for the moment. So it tells us that the cost of equity for the levered firm is determined by the cost of whole assets, okay, the overall cost of capital. Is also determined by the debt to equity ratio or the level of a leverage, and also the difference between the assets return and the cost of debt. But we have a very strong assumptions here. So these assumptions are either there's no taxes or there's no transaction cost and individuals and corporations borrow at the same rate. Remember from the homemade leverage topic, we assume that the individual can borrow and lend just as the same as corporations can borrow and lend. So right here is the proposition for the return equity. You have a debt to equity ratio as the horizontal axis, the cost of capital as the vertical axis. So the cost of debt really does not matter. It stays flat no matter how high your leverage is. The cost of a whole firm, okay, R0, is the WACC. As I said, we just don't put a tax rate in there. So it's the debt ratio times the cost of debt plus the equity ratio times cost of equity. And based on this formula, you derived the cost of equity. It is the overall cost plus debt ratio times cost of total capital minus the cost of debt. As you can see, if your debt ratio increases from 0 to a maximum 100%, then your cost of equity just increase linearly. All right, so that's what we have for the Modigliani and Miller theory. So proposition 1 tells leverage has no effect on shareholders' wealth, and proposition 2 tells that the cost of equity increases as debt ratio increases. All right, and here we do need to consider corporate tax. If we consider corporate tax, you will see that the tax actually adds some value to the levered firm. So now we have a discrepancy of the values of levered firm and unlevered firm. Clearly, the value of levered firm could be larger because we add this tax component. So you have the tax rate multiplied by the debt ratio. And in the second proposition, the cost of equity is the cost of total capital, okay, the overall capital plus the debt ratio, debt to equity ratio times 1 minus tax rate right here, okay, and this multiplier still is total cost of capital minus the cost of debt. So what you see in this chart that is that when you consider the tax rate, the WACC actually declines a little bit. It's not staying flat anymore if you consider the tax rate. I'm not going to do all the math derivation, so you just need to trust me that the WACC would slightly decline if we incorporate tax there when the debt to equity ratio increases. And right here for the cost of equity, it is also changing when we incorporate 1 minus tax rate into the formula. You can see the slope is actually going down. So the increase of a leverage from left to right actually has a lower or a less effect on cost of equity. And for more exercises, we can refer to case 31 from the textbook. So why so? Why does adding tax makes a difference? So what you see here is for all equity firm, when there's no, let me put it here, when there's no debt considered, you will see that this is a total cash flow. And for the shareholders, that's what they got. And for levered firm, when you do have a debt and when you do pay interest, so this is the shareholders return. What you see here is 234, 884, and 1534. So these are the shareholders' cash flow under different economic conditions, and this exercise is covered before. But you also need to consider the return to debt holders. Okay, the return to debt holders right here. Use B is for corporate bond, which is also debt. Under each circumstance, you will have 640 paid to the debt holders. So for the shareholders and the debt holders combined, then your cash flow would be higher than the cash flows for shareholders when there's no equity. Okay, you see 874 is greater than 650, 1524 is greater than 1300. All right, and this can be derived. These numbers can be derived based on just simply adding the cash flows to shareholders and the debt holders. You can also derive the same result by using EBIT minus times 1 minus tax rate plus this tax shield, and this is the tax rate times the interest rate times the amount of debt. So let's get back to our equation. All right, so the value of a levered firm equals to the value of unlevered firm times the tax rate plus the tax rate times the amount of debt. All right, so for all equity firms, all the money made from the operating of the company will be shared between the shareholders, as is for shareholders, and the government paid for tax. And for a levered firm right here, all the money made, which assumes the same money made, will be shared among shareholders, debt holders, and the government. Because of the existence of the debt, the government get less tax revenue. Okay, so the investors, shareholders, and the debt holders combined get more piece of the pie. So for more exercise, as I said, we just go over the textbook case 31, where we collect all the beta, we estimate the beta, we use a debt ratio, and we have the company's average assets data, and then we estimate a cost of equity, and then we derive the value of a levered firm and compare it to the value of an unlevered firm, and see the difference would be the tax shield offered by debt.